Now for this session, investing and prospering in an economic regime, it really is different this time. Our expert panel, a mix of CIOs, investment professionals, consultants and practitioners, will challenge you to think through the implications of the new regime for constructing multi-asset portfolios and for the investment conversations that you have with your clients. A qualified, experienced investment advisor and an investment committee chair will help to translate the outcomes into practical implementation steps for investment advisors. So let's hear about our facilitator for today. Graham Rich has been involved in the provision of investment information to advisors for over 40 years, and the first 20 years were spent establishing, growing, selling the business which became Morningstar Australia, a very familiar name to us all. Over the past 2 decades, Graham's established and grew Portfolio Construction Forum, an investment education business. And the forum now has 14,000 members who regularly attend its programs and engage with its content. So I welcome Graham to the stage, but we'll play a video first.
So you should all be pretty clear about how to use your app. So get it out and answer this question that's up in front of you. And while you're getting that out, I want you to take 1 minute to talk to somebody near you. If you want to stand up, let's stand up. But 1 minute to express something you think that represents volatility or uncertainty or complexity or ambiguity. And when you start, don't start with the V because it's first. Maybe think about going down a step or two and say, here's something that impresses me about volatility, uncertainty, complexity, or ambiguity. Who would have thought just 2 months ago that there'd be 2 wars running in the world? Probably no one. So turn around, stand up, take a minute, and express something about one of VUCA to one of your colleagues. Go. It's not hello, it's VUCA. Okay, for the person who said say hello, now you can say goodbye. Let's carry on. You've expressed something, you've polled something. Pretty well nobody disagrees unless you're sufficiently stupid you can't find the button. But 78% say VUCA is around. And you know, VUCA hasn't just started. We kind of thought for 20 or 30 years that VUCA was gone. There was no such thing as all this mess. But the reality is we're talking today about a new regime. Let's go off the slide now, please. And here we go. Why don't we move the slide? You're back to it. Good man, thank you. And let's introduce our panel, because they're going to deal with a series of things. There's 5 of them. So we're going to deal with 5 things, and you've already heard Jade say these are eminent people. She started out and said expats. I think there's 2 or 3 expats on the table, on the stand. A Croatian. Where are you from, Jack? Another one? India.
Parents are Italian.
Italian.
Scottish.
Scottish.
Born in Melbourne.
Well, you can't be a Scottish born in Melbourne. Anyway, and I'm a Kiwi, so there's a bunch of yous, and what we want is you to be feeling like you can interact today, if not openly with questions, at least in your head to think about, is this a new world and what am I doing about it when it comes to thinking about investing? So there's the challenge in front of us. These folk have each got different types of roles. Probably Jonathan and Angela are more similar. And then, as we've heard, Mirko will be trying to draw some threads together and give some observations as a practitioner and as an investment committee chair. Volatility, uncertainty, complexity, and ambiguity. Here's something I believe. And I'd like you to think about, is this what you believe? Because, you know, without VUCA, my suggestion is none of us in this room would have a job. If everything was so certain and stable, why the hell would you need advice? You wouldn't. So we should embrace the fact that everything is stuffed up everywhere, because that's what gives us the potential to add value. Here's some context for you. We've got this VUCA surrounding the space that we are part of. The wealth system, the investments system, and ecosystem that we're part of. VUCA surrounds it, and we ought to embrace it and embrace it with our clients. And sitting in the middle, I would contend, of everything we do has to be a strong heartbeat around quality investment portfolios. That's the centerpiece of everything we should do. And I kind of take it personally that we're not jammed to the gunnels and there's a queue outside, because everything ought to be about how well do we do putting investment portfolios together. So when we take that little circle in the middle of a portfolio, here's a kind of easy way of describing it. It's some stuff about education, that's what we're part of, and that's what Portfolio Construction Forum does. There's some researchy stuff that goes on, and that's what we end up subscribing to, often external research. We do some ourselves. We have a duty of care, a duty of responsibility to do some of our own analysis. And then there's some implementation functions, and so we have platforms and everything else. But now when you look at that education piece, how do you divide that up, and where do we fit what we're doing today? Well, there's the function of what we call strategies, putting portfolios together, but sitting around that, there's a set of things that we call the investment factors, and that's what our team today is going to be focusing on. Really, the investment factors in portfolio construction. You right there, mate? Good. It's all right, no problem. And then sitting around that is the human factors, and there's some stuff on human factors. I see Dr. Catherine Hunt sitting here, and tomorrow she's going to be talking about things to do with human factors in portfolio construction, and we've heard some things about that already. Today is investment factors. What do we mean by that? We mean understanding investment markets and investing, those two things up on the top right. That's where we're focusing today, but that's just a piece of a piece of a piece of a piece of all the things that we need to get our heads around to do a good job coping with VUCA. So the content we're dealing with allows us to say, investing and prospering in a new economic regime, it really is different this time, and the case we're putting to you, which ultimately we want you to agree with or disagree with, is that the case? Do you agree with that? Well, here's 5 topics we're going to deal with, and with each of those there's a poll question. And by the time we could have 55, but we've chosen 5 things. And it evidences the fact that this is a complicated world that we're part of, and we are representing ourselves as those who are able to distill the complexity and turn it into simple concepts that can be grasped by individuals to do something active for their financial future. So here's the 5 topics we've chosen. Invest in yesterday's themes or get ahead of the next regime shift with Jonathan Ramsey. And here's his slide that he kicks off with. Jonathan Ramsey, please welcome Jonathan Ramsey of InvestSense, Scottish, born in Melbourne. You can trust him.
Thanks, Graham. And this
Oh, you got a second clicker.
is this the clicker?
Well, that's
Got two clickers.
amazing. Here, I'll take one. You Scottish man can't deal with two
Little
things.
pointy thing. Good.
That's it. Don't do the pointy thing. Just look at the audience.
Now and then, anyway. So, yeah, I've actually been in Australia since 2000. One of the themes I'm going to talk about is investment regimes and why they're different from business cycles, and why some of our preconceptions about how we invest sort of get challenged at certain points in the cycle. But, you know, when you see this chart, and that was actually my punchline, but...
I'll go back.
No, it's good, Everyone's
Right,
seen it now. You can't unsee that graph, can you? Because it's about our industry, and, you know, don't feel bad about it. We all do it. Retail clients do it. Advisors do it. Asset consultants do it. Institutions like Aussie Super do it. Even educated fleas do it. We get hold of a narrative, and the more singular the narrative is, the more tempted we are to just jump into it at the wrong time. And my preamble was going to be, with all this talk about economic regimes and change and VUCA, it kind of makes you want to go and do something. Go and find a theme and go and invest in it. Well, these charts showing the performance of indices related to a particular ETF, you know, think of it as a parody of, you know, the investment world. The line on each one is before, and the one afterwards is when they were launched. And you can see that the more singular the theme, the more compelling it is at that point in time, the more we seem to outdo ourselves. Actually, I often say, you know, with respect to this graph, that you know, people say we can't do market timing as an industry. I reckon we can. It just doesn't always work. So this is a little bit of a sort of busy chart, but basically it's the US market in the post-war period. And how many people here have said to their clients or implied it that if you're 100% growth, then you know, invest in equities, you know, because that stuff's too difficult. Just invest for the long term, and you know, she'll be right, mate. See, I can talk Australian. Here you can see even the most successful economy and the market attached to it, which trades on, you know, arguably the highest valuations at the end of that period, even that has had lost decades twice. And, you know, it would be sort of improbable, you know, even in the most successful economy in the world, bar one or two actually, to not end up in a period during your career where you promise that client that she'll be right after 10 years, and in real terms, you're even worse than that. So it's something we're all going to have to deal with. Now, I said that I came in 2000. I do feel quite lucky in that I left London in March 2000, just as the dot-com thing was starting to bubble up. And then I went backpacking for about 3 months, and I came to Australia, the bricks and mortars economy, and I completely missed out on that. So I'm not exactly a well-seasoned investor. But neither are all of us actually in the room, because an even more successful economy over the last 40 years at least has been Australia. Because GFC, we didn't really have it like elsewhere in the world, and we actually haven't had any lost decades. Going to the other end of the extreme, this is Japan. So obviously fantastically successful, rebuilding after World War II, and then 3 lost decades. Now, just have a think for a moment. What was the tell in all of that? I haven't done 4 minutes already, have I?
You have, yeah.
Oh my God, I can go on. All right, very quickly. High valuations, I'll skip that one. This one just says basically the same chart, but this green line says when something's very expensive down here, very cheap up there, and whenever that thing seems to, there should be a dotted line there actually, whenever it spikes, something seems to change. Now, my punchline, I'm going to skip that one as well, is this chart here. Take a picture of this one, show it to your clients, and just read through that, probably in your own time. Peak oil, 1980s, we thought that anyone who held the limited oil resources was going to own the world. Well, we still haven't had peak oil, not quite yet. Japan, 1990, you get the story, 2000.com. By 2010, China was going to take over the world. Hasn't been a great place to invest. So oil down 30 over the next decade, down 50% over the next decade in Japan. NASDAQ you know about. China up 40%, but still 140% behind the US. So look at that last one, and do you feel lucky, punk? Think of the Clint Eastwood thing. And that's more or less me. I know that's a bit boring. It's saying do nothing, but I've got a feeling that in the panel session, we're going to talk a little bit more about what constructive you do. And my main proposition is now is not the time to jump on the theme because of VUCA, because there's uncertainty, but it's time to sow the seeds and think about, as things settle, what the themes will be. And I've got a few ideas that we can talk about later.
Okay, thank you, Jonathan. I like the way you said that's me more or less done, and then he carried on for a bit. What do you think? Invest in yesterday's themes or get ahead of the next regime shift? There's the question. So Jonathan's mission was to talk with you about this topic and have you be able to draw a view. And because Jonathan skipped across a whole lot of charts, which he intended to do, you'll be able to get those charts later by going and re-looking at the deck that's up on the Learn site. So what's your view? So the challenge is, how on earth do you get ahead of the next regime shift? I didn't check, but I suspect that poll stays open. Can we leave that open while we move on? Okay, we can. So if you want to change your mind or you think about it a bit further, let's do that. But meanwhile, let's take it off the screen. Thank you. And we will push ahead, there we go, to Angela Ashton. And Angela is kind of picking up a little bit from where Jonathan has left off, is in the same general space. And Angela's 4 or 5 minutes is dealing with this relationship between equity and debt. And I suspect what Angela is saying here, amongst other things, is there used to be one way of looking at things, and here's another way of looking at things. Fair enough, Ange?
Yep. Okay. This one you should also take a photo of. It's my only chart. So I'm a girly SWAT, and I measured out the 4 minutes. So I'm not going to go to 7. I'm that sort of girl. But let me just start with this. This is very important. The relationship between asset classes differs over time. And the problem that a lot of us have when we think about portfolio construction is we think that they are stable, and they are not. So I'm going to talk today primarily about the most important 2 asset classes and how they behave over time compared to each other. So that's correlation. So you can see here over the last 20 years or so, stocks and bonds have had a negative correlation. So that means when one goes up, one has gone down. And we all know that in portfolios, right? So when stocks have fallen, bonds have saved us a little bit. They've gone up because interest rates have gone down, and they've meant that they've been a little bit of a risk absorber, let's call it, or a return absorber in portfolios. So that's helped. And a lot of us now think, after 20 years of this regime, that is actually some sort of truism, that it was sort of, carved in rock somewhere. That's not true. These relationships change, and they change regularly. You can see that the 50 years before that, bonds and stocks were correlated. So when one went up, one often went up. Not all the time, but a lot of the time, they both went up together or they both went down together. Now, when there'll be a number of people in this room that used to build portfolios in the 90s. I certainly did. I worked at a few places where I worked with advisors back then. And the way that we talked about stocks and bonds was a little bit different. The way we built portfolios then was we thought about stocks being the return driver and bonds just helped dampen volatility. That's all it did. We didn't think about that idea that they were negative. And something subtly changed over the years when these correlations changed. And we started to think of bonds in a very different way and stocks in a very different way. And we started thinking about portfolio construction in a subtly different way, but a very importantly different way. And the relationship between these 2 assets and every other asset class changes and is important when you think about portfolio construction. So my next question, or my next thought bubble, is really about what do we think is happening with correlations now and where do we think they're going to go? Because that is obviously extraordinarily important in the way you need to think about building portfolios for your clients and how you present them to your clients and how you talk to your clients about performance. So, lucky for you, I have spent the last 6 weeks reading PhD theses all sorts of journal articles and all sorts of other articles on this exact topic. What drives this sort of correlation? So there's lots of stuff. There's lots of factors, but there is one that comes up in the research over and over again. To different levels, there's different types. They have different types of, effects on this. But the one thing that drives this relationship, probably more than anything else, is inflation and inflation volatility. So one study I read actually suggested that 98% of the time when inflation is over 3%, stocks and bonds are positively correlated. So if you think in any part of your mind or in any of the conversations that you have with the market specialists you employ, that inflation might be a little bit higher than central bank bands, that 3%, 3.5%, and might be a little bit more volatile than the last 20 years, then you need to start thinking about the relationships between asset classes, because they are likely to change. And how you have to think about portfolios as a result needs to change as well. And I'm right on time. Thank you.
So you know about this poll, nobody knows what you vote. So you can be confident in your anonymity. So only put number 4 if you really thought number 4 before you arrived in this room. What do you think to what it is that Angela just put to us? Was that something you kind of understood when you watch on TV, the cost of living crisis, inflation? Does it drop down in your mind to the consequence being this relationship between two major asset classes? And is that what starts to ring a bell in your head about how do I need to think about investment portfolio construction? So if you join some dots, what I was trying to say in the beginning is if this green bubble in the middle of the investments and wealth ecosystem of putting portfolios together is so critically important, how well are we thinking about what it is that's going on inside of that portfolio design? So there's the answer. Majority of people saying, that's something I need to do a bit more work on. And a whole bunch more people saying, yeah, I'm not convinced yet. And I would argue that that's probably a good answer, Ange. It's like, it doesn't matter if you're not convinced or you're convinced and going to do some work. Go away and think about that stuff and work on that stuff. And I'm sure Ange or Jonathan would be more than comfortable sending you material to say, hey, have a look at this and read that and do this and do that. That is, to me, part of what the whole essence of continuing education and the commitment to continuous learning is all about. All right, let's stop there and kick on to the next session. And this is where we're starting to move away from some big picture stuff to say a little bit lower down in the process of thinking, well, how do you deal with this in a disruptive environment? So here we have an investment manager, specializes in global equities, but in particular in the disruptive space or disrupting space. Please welcome Anshu Sharma to the stage.
We'll stay on that slide. Thanks for the introduction, and good afternoon, everyone. We manage a global equity portfolio with a disruption overlay, and have been doing that for almost a decade out of Australia. And I'm telling you that because it's quite relevant to what I'm about to present now. So we all are living in a very uncertain macro environment right now. And the overpowering rhetoric out there, which is on all the investors' mind is, essentially the overpowering rhetoric on all the investors' mind is of doom and gloom. The question investors are asking is there somewhere we can invest which is less macro-dependent and more secular in nature, where the secular growth can compensate for the cyclical weakness we are seeing in the market? One such area which has exhibited this time and time again, and continues to do that even now, is essentially this relationship between technology and economic growth. This is a beautiful chart from Microsoft, and it's quite stunning. In the last 1,000 years, for most of the 1,000 years, there was not much economic growth, and there was not much technology. Then something changed about 250 years back. You saw real progress. And in the last 70 years, the steeper part of this curve has been dominated by information revolution. We should stop here and ponder if this is a solution to investing in any macro environment, and not only just this one. I was reading earlier in one of the books, the author puts it like this: if a technology is desirable, if a technology is useful, it's accessible, it's affordable, and it's unsurpassed, then that technology would flourish. And when it flourishes, it will compound. And any civilization's appetite for a cheaper and a better technology is boundless, it's limitless. And I don't think that's going to change in my lifetime or in the lifetime of my kids. So moving on to my next slide. Banking brought GFC to us. It didn't get us out of GFC. The areas which were growing for the last 15 to 20 years are areas, some areas like e-commerce, digital advertisement spend, smartphone growth. These all are secular trends. And they are not growing because we are in a very loose monetary policy environment. They are growing because of only one reason, that they are economically viable solutions. And that brings me to my next slide. It becomes extremely important at this point to differentiate between substance and stories, because we all must be hearing, we all must be reading a lot about new secular trends. We have to have a process to understand what is a story and what has got substance to it. Because when you invest in stories without thinking about the substance, you possibly will have negative investment experience. And a lot of people would have realized that in the last 18 months, and a lot of people would have realized that multiple times in the last few decades. When I talk about substance, I'm talking about revenue growth and earning growth. And the areas where we are seeing revenue growth and earning growth, and we have been tilting our portfolio for the last 18 months and kind of placing our portfolio for the next 2 to 3 years, are some of those areas are these. Essentially, these are semiconductors, software-defined vehicles, streaming services, and AI. And moving on to the next slide, I think this is our QR code. You can go there and check what we are saying about AI, and that's pretty much me. Thank you.
So remember I said at the beginning, embrace VUCA. It's nothing new. It's just that it's become more prominent in our minds as well as perhaps in reality. So here's the question: innovation and disruption continue to deliver. Have you got enough information to make a decision about that? Let's take a look and see what you think. How much do you focus your effort? And in a way, you could extend what Anshu has covered beyond just the way you look at investment opportunities and funds. You could also extend it to the way you engage with your clients and encourage them to embrace the challenges that exist, if that's part of what you want your philosophy and policy to be. So that's partly what we're asking here. All right, let's move on. And here we go. So Jacqueline is going to put a case that says, oh, hang on just a moment. Let's just not rush ahead too fast here. Please welcome Jacqueline Fernley.
We believe that the direction of inflation and growth and the combination of those two factors is the key determinant of asset class performance over time. Based on data back to 1871, the stock bond correlation is negative when inflation is under 2% and positive when inflation is above 2%, very much like Andrew was just talking through. So a secular inflation backdrop where inflation is above 2% potentially means that diversification benefits of bonds in a portfolio, in a multi-asset portfolio, is no longer valuable. Sorry, that should have been up there while I was talking. I was always taught as an investor to take notice of 3 standard deviation events. In my view, the coming AI wave has the potential to be a 3 standard deviation event. The expectation of secular inflation has become a consensus narrative. And I would contend that the key question of the day is whether or not AI is actually going to have an implication to this secular inflation trend. McKinsey forecast in 2017 when they expected AI to deliver to or above human capabilities across key segments. Roll forward 5 years and post the release of generative AI, they have now brought forward that expectation in terms of time frame. The human mind is wired to think linearly, but the universe runs exponentially. This is why we so often underestimate the power of new technologies. McKinsey also recently brought forward by an entire decade the point in which it expected the workforce to reach 50% automation. It's roughly 20 years' time. What does that mean? It means between now and then, there will be significant disruption in the way organisations run their businesses. It has significant implications for the economic environment as well. The fact is, the impact of AI on inflation, productivity and growth is unknown, but has the potential to be very large and potentially a 3 standard deviation event. Many around the world are endeavouring to forecast this, with GDP impacts ranging from between 4 and 7% per annum and productivity gains of between 0.2 and 3.3% per annum. And with all of those intelligent minds focusing on this analysis, there is not actually consensus opinion as to whether or not this will be inflationary or disinflationary. In fact, I actually asked ChatGPT for its view, and it told me that it was complex and unclear, and it was a hotly debated topic amongst economists and experts. Not exactly the answer I was looking for. So I would argue that whilst there is no doubt credibility in a secular inflation environment, we should hold it lightly because in my view, AI, if it is as big a deal as many are suggesting, we should look for higher growth, higher real interest rates, and lower inflation.
So there we go. How do you respond to that perhaps somewhat contrary perspective? Not maybe radically contrary, but it adds a confusion point, maybe. We'll take to that in the question time. And of course, Mirko is a SEMA certificate, so he knows the answers, and he'll tell us what he thinks in a moment. Is that right, Mirko? Good, got it. Okay. So what, to me, this is showing us is that Jackie's proposition almost raised more questions than answers. It said, hang on, I've got to work this through. And that's, in many respects, the point of this exercise. Let's push on, and like I've said, all the polls will remain open for you. All right. So Mirko's going to give some perspectives as a practitioner of how does he synthesise perhaps conflicting views, different perspectives, some from the top down, some from the bottom up. Some are what we've described as investment factors. And then there's been a couple of touches on the way regarding behaviour and human factors. How does Mirko synthesise those things? And then we'll go into a time of Q&A where you can put the questions through to the tablet, but to be open, I reckon we're a small enough group that you can just stick your hand up and grab a microphone and call it out. So, Mirko, please welcome a Melbourne lad, Mirko Kagura.
Thanks, Graham. Graham asked me for my slides about 15 times last week. I don't have any slides, but he's put the SEMA Society ad up for my sins. Full disclosure, I'm a board member of the SEMA Society. What I'd like to talk about today is the investment committee process, and we've heard today from asset consultants and portfolio managers, and how do we put all this together? Now, I know in the room there'll be varying degrees of investment committee involvement. You know, there'll be chairs of investment committees, there'll be CIOs, there'll be some people that are simply recipients of investment committee outputs. But it doesn't matter whether you're a one-person show from an investment committee or you have this, massive convoluted process. The reality is we need to think about how we actually construct our portfolios. And the question that I pose is how committed is our investment committee? How committed are we to ensuring that we're constructing solid portfolios? So looking at what are the ingredients of success, I sort of put it down to 4 key ingredients of success for investment committee success. One of them being diversification. Now, we've all talked about diversification at an asset level, making sure that we've got plenty of asset classes in our portfolios and some to varying degrees with correlations and the like. But I'm talking about diversification of our investment committee and diversification of the personalities on our investment committee. So a good way to do this is to have an investment skills matrix where we have a good understanding of what skills people bring to the table. It might be specific asset class expertise, or it might be geopolitical views, might be it could be asset consultants, both internal and external, that comprise that. But getting that diversification right in your committee is really important. Secondly, I think that you need to have a rule book. You need to understand how you go about making your decisions, and having an investment policy statement, an IPS, and an investment committee charter is really critical to being in a position to understand how you go about making your decisions, what your governance looks like, how you assess risk in your portfolios, what sort of metrics are you going to use to assess that risk, and how you actually go about constructing them. Is fees a big issue for you? Is that one of the driving motivations behind the portfolio construction? The third point that I'd like to raise is the notion of defined responsibilities. And like I said, it doesn't matter whether you're the chief investment officer, the chair, or the person that actually takes the minutes in your investment committee. Everybody in that room needs to have a role, needs to be clearly defined, and they need to be an active participant. It really needs to be a no passenger type policy. And the fourth, and I think the most important one, and none of you would be in the room today if you didn't believe in sort of continuous education and developing your own skill sets and the like. And I know that a lot of us were forced back to go into study and do exams and postgrads and degrees and God knows what else over the last years. A lot of us had enough of everything. But as far as developing yourself and expanding your skill set, I think that the truly committed investment committee is actually doing that. They're actually constantly evolving their skills. And how do you go about doing that? There are plenty of opportunities to do that. Today is a perfect example of that. There are certainly courses you can do, the SEMA certificate, the CFA, the Chartered Financial Analyst. There's short courses in behavioural finance, in specific asset classes. If alternatives, you want to get deep dive into alternatives. I think that you need to be prepared to do that, and I think that it's great to have this panel of people with us today, because we have got chief investment officers, we've got asset consultants, we've got educators, and one thing they will tell you is that the committed investment committee actually asks better questions. They have more meaningful discussions amongst themselves. They certainly have more meaningful discussions with their clients, and they have deeper relationships with their clients as a result. So my message to you from that point of view is, how committed is your investment committee? I can assure you that the clients are actually asking that. They want you to demonstrate that. It might be through your communications, might be the way that you put your portfolios together, because 100% in the background, they want to know how committed you are to their investment success as well. Thank you, guys.
So I don't make any apology for the fact that Portfolio Construction Forum is focused on what we call quaternary education. You know how it goes primary, secondary, tertiary, and then quaternary is the next word in that sequence. And we take that to mean that's a commitment to continuous learning. It's not just saying I'm on the job, it's saying the stuff we've all been through the last 3 or 4 or 5 years, that should be just whetting the appetite to say, hey, there's this continuous commitment to learning and developing expertise, subject matter expertise, in specific and definitive areas. So there's the challenge from Mirko. He's disclosed he's on the board of SEMA Society, which is like a specialist association for those focused on investments as an aspect of their overall advice. What do you think about this question? And that's a terrific answer to me, is a group like this, and you're kind of proving it by being here, saying, yep, I know it's how it is, but we've just got to keep ourselves with sort of nose to the grindstone, shoulder to the wheel, whatever else you want to say, working on new ways of learning, new ways of developing knowledge and skills and mastery and expertise in this subject that is so critical. So let's now wrap this part of the session up and move to this summary of all that's been going on. So I'd like you to take just another minute. If you want to stand up and spin around and talk to the person behind you, that's fine. But take a minute to say, well, what's one thing that I've picked up out of what we've been having conversation about so far? And then we'll go into Q&A with our panellists. So take a minute amongst your colleagues. You've said hello, so you don't need to do that bit. Just carry on with what's one thing I take out of what we've just covered. So you guys have got your microphone? I don't know if they turn them on or you turn them on. What is it? We'll work it out.
Oh.
Ah, thank you. I didn't notice.
Good.
Here we go. So I've got a question on the app, which is good, but before we ask that question, you may have other questions you want to put in, but I'd encourage you just to be prepared to hold your hand up, and we've got a couple of microphones that we can roam around with. But I'm going to just walk through our 4 panellists through, exclude Mirko for this part of it, and say, so Jonathan, quick observation of what you would take 30 seconds as a synthesis of all the things you've heard when we say investing and prospering in a new economic regime. It really is different this time. What's a quick takeout you've got? 30 seconds.
Well, obviously, I'm going to sort of focus on the investment stuff, and I thought those two presentations on inflation kind of underscore the point that we don't actually know what comes next. That's the interesting sort of puzzle about it. And just as you said in the first instance, that's what's going to be the challenge over the next few years, is communicating that to clients as this thing comes into view, this new regime. Yeah.
Mm-hmm. Ange?
Yeah. Look, I'm not sure about.
I think it's on.
Hello?
No, I think you turned it off.
Thank you. So for me, I guess, yes, the inflation, discussions were interesting. I guess the thing on the other side of the AI argument for me is the climate argument and how much money needs to be spent on the greening of the economy and how inflationary that might be. So I think that's something that people need to think about. There's a natural, juxtaposition, I guess, happening there. But I think, look, overall, VUCA is the clear issue here. We don't know what's going on. It is an extraordinarily ambiguous period, and what's to come is really up for debate.
Thanks. And Shu?
Okay, that's good. I think pretty much in line with them as well. A lot of uncertainty around, and then I think everyone is trying to understand which asset to buy and where to go in. For us, I think listening to Jacqueline as well, to me, few things are very obvious, which are long-term in nature, which is disruption and AI. Good area to look at if you are concerned about the macro.
Thanks. Jacqueline?
I think for me, it is being very clear in your investment committee setting what you're holding tightly as a view and what you're holding lightly or loosely as a view. And I think your historical relationships, just as we're seeing that in this economic cycle, they break down and they change over time. So you be very clear in what you're anchoring to and why, and be prepared to be nimble in your thinking, because the world is changing, and what you've just heard is that none of us have a clue about what's really coming.
And in a lot of ways, that's a virtue to share with your clients, in my view, is I'm not some guru sitting here, I've got all the answers. It's how we manage our way through the rapids. So Mirko will be familiar with this statement, I'm sure, because he's heard me from time to time, as has Ange. There's a fellow called Peter Brook who had a statement that I use when we're talking about your investment philosophy, which is kind of woven its way through here. And his statement is, in summary, hold on tightly, but let go lightly. And so it's super critical that we have clarity, and that in a firm you have clarity, that you in your own mind have individual clarity about what is it you believe about the investing thesis and about the style of investing. Mirko, take a moment just to connect that word philosophy with the investment committee. You talked about investment policy statement and so on. Talk about philosophy for 30 seconds.
Yeah, as far as philosophy is concerned, I think the guys hit the nail on the head. We need to be honest enough with our clients to say that we actually don't know what's going to happen next, and I think that's been the common theme, and particularly in an area of increased volatility and the like. With your investment philosophy, yeah, definitely you need to have one, embrace it, and have a way that you manage money for your clients, and be able to articulate that very quickly for your clients. It could be something as straightforward as ensuring that your clients are never forced sellers, of their assets, that there's enough liquidity provision for them, because the reality is we don't actually know what will happen next. So as far as tying all that together, having an investment philosophy that you're prepared to stick to, that is the way that your business manages money for your clients, I think that's really important, because your clients want to hear that from you. They don't want to be coming up with that themselves. They actually want to understand that one of the primary reasons I've employed you is because you actually run money for my family, for my wealth, for my intergenerational requirements. So having it articulated, and that's something that is a go-to for every investment committee decision. How does this represent what the business's investment philosophy is? How does this represent what our investment policy statement says? And if you can continue going back to that, at least you've got a bit of a checklist in your own mind as to how you guys go and formulate your decisions.
Okay, so that's a kick-off of the on-the-spot reactions to the issues that are in front of us. You've got some questions here. I've got 4 or 5 of them. I'm going to come to them momentarily. But who's bold enough to put their hand up and ask a question from the floor? There we've got one over there. Thank you very much. Pass the microphone. Please just identify who you are and if you're asking a specific question, and then we'll be super quick on the answers. Thanks.
Yeah, hi, my name's Richie Parsons. I run 2020 Financial Planning. First, a statement that some Graham may appreciate. My kids never listened to me and I've never listened to my father. One of the times I listened to him, he said, don't believe anything you hear, only half of what you see. So I think today's theme has been a bit of that. The question I have for the panel is, what keeps you awake at night? What do you really worry about and what you do in running your businesses or managing clients' money or asset allocation, those types of things?
Thanks. Quick answers down the panel. What keeps you awake at night in this space? Let's go to Jacqueline first.
Right now is whether or not this in this recession that we all expected at the beginning of this calendar year actually hits us in 2024 or not, and whether or not I have enough insurance in client portfolios to get us through to the other side.
Okay, Ange.
Yeah, no, it's okay. Probably not dissimilar. I think leverage, and where leverage might pop up over the next 18 months, 2 years.
Thank you. And Shu?
I think on the leverage and financial, I'm quite happy with where the clients are investing. My biggest concern is some idiot up there in any of the countries and the geopolitical risk, what they can do to the world. That's my biggest concern right now.
Okay, thank you. Johnny?
So as I alluded there, I think we've got to be careful about what we promise because sometimes we're not in control, even over 10 years. So CPI plus, say, 3% for a 70-30 type fund. And I was a bit ambiguous there because, and I do have some opinions, which is kind of what you came for, so maybe we're going to get into that. And I think there's things that we can do to get to CPI plus 3, for instance. One of those charts that talks to that. But I worry that potentially your future, your super, will absolutely stop us from doing that. Because I don't think, and this isn't about active or passive, a lot of those slides are about looking out the front window. And there are things that we can do, but they involve tracking error at an asset allocation level. And I think we're possibly about to be heavily discouraged from doing what we need to, which is not actually complicated or difficult.
Mirko?
Yeah, one of the things that keep us awake at night is actually the VUCA concept and falling victim to it and actually losing focus. So being in a position where, as a business, you actually have a very clear mandate as to how you're going about things and you do not get caught up in all the noise. Because if you just look at Australian equities, for example, over the last 12 months, and the cause for 9% up, 9% down, 8% up, 7% down, there actually has been no cause because fundamentally those businesses have been exactly the same. They've actually been little, bits of news and data points which haven't changed anything, yet the market's reacted so violently. And I think that, being nimble as an investment committee is great, but overreacting and getting caught up in that is a big problem.
Okay, let's take another hand. Somebody over here. Here's one. Thank you. Thanks. Go for it.
One of the comments that slipped through was that the Australian market has never had a bad decade. And if you look at the charts produced by Vanguard, those really brilliant 30-year charts that track a person who's invested 10,000 Aussie, converted it to whatever currency, and then invests in that place, that be it US equities or whatever, and then brings it back to Australian currency at the end. That's absolutely right. Is that going to continue?
Okay, just identify yourself at the end, please.
James Hodder from Helm Capital, Perth.
Thank you. Okay, who wants to grab that? We won't go right through the panel. Who wants to grab that about the decade? Do you want to try that, Ange, seeing you were the decade person?
No, I wasn't the decade person. I think Jonathan was. But I will say a couple of things. I don't think it's completely true that Australia has never had a lost decade in equities. If we talk about the media in the past couple of weeks has had that, sort of the stat that the All Ords is at the same level it was in the GFC at about 7,000 or just before the GFC. So the reality is over the past 15 years or so, all we've made is dividends and franking credits, which is not a lost decade, but it's also not an incredible decade. So I'm not sure that's completely true, but in terms of the Australian market, I don't know the answer, but one of the really interesting things about the Australian market is it's the highest yielding market in the world. And franking credits, we're the only country with franking credits, which makes it very special and very different. And if you look back to records, Credit Suisse does a thing every year, and they do markets from about 1900 or so. The Australian market is the best returning market overall globally since 1908 or whatever the date is. So that dividend, the constant dividend, is actually really valuable and really does sort of, provide real support to the Australian market.
Okay, Jonathan.
I think it's all about probabilities. So we could be the lucky country for a while longer. I think we've got some things that were tailwinds turning into headwinds. But, at the end of the day, and a slight counterpoint to that is, back in the 70s, it was a high, we would have reputation. When I arrived here in 2000, Australia still had a reputation as a highly cyclical economy. Going into the GFC, it still did. And then we kind of got lucky. I think structurally it is a very cyclical economy. So if we have a downturn, there is a chance that we feel it more strongly than others if there's not someone out to sort of hit the stimulus button. But in certain scenarios, we could still do very well. As Ange said, starting with a high dividend yield, and growth just has to be okay. But it's a question of probabilities, and I think I'd sort of finish on just thinking about how many eggs you've got in that basket, and in the Australian basket, how much concentration, because these things are all highly linked.
Okay, thank you. So I'm going to rapidly rip through these questions that have come up through into the app and have one person give a quick answer. Comments on assessing less liquid assets that appear to give the appearance of diversification but are still driven by the same risk factors, e.g. private equity infrastructure compared to public markets. Somebody want to make a quick comment on that?
Depends how many private debt managers there are in the room.
Okay, quick answer.
Oh yeah, it's a risk, definitely.
Okay, anybody want to disagree with Jonathan?
No.
Okay, in terms of diversification, having something that's negatively correlated to equities is good, but still needs to pay its way. Aren't lowly correlated assets still good for portfolios?
Yes, absolutely, yeah. Anything that's not positive, like a full 1%, is obviously valuable in terms of diversification.
Okay, let's go to Jacqueline for this one. What's the outlook for equities in 2024?
I think the beginning of 2024 has the potential to be volatile. I think we will likely see some softness in economic variables, specifically in the employment data coming through, and that will probably create some volatility in markets, in risk markets in the near term. But beyond that, I don't see a deep recession at this point in time, and therefore on a 12-month view in this context, as the question asks, I'm reasonably bullish, but I'd be ready to put new capital to work.
Anshu, agree, disagree?
I normally don't have views on the markets.
Okay,
there
next person.
are a lot of companies which are cheaper right now where you can invest.
Okay, thank you. Anybody else want to add to what Jackie has said about outlook for next year for equities?
Yeah, look, I don't believe that we've actually seen the impact of interest rates just yet. I think that lag effect is yet to come, and I think 24 is probably we're going to see a lot more of that effect coming through the economy.
There's a question from Bradley who says, what is the next regime, or what signs do we need to be looking for? I'd kind of contend, and Jonathan can disagree with me if he wishes, we are in the next regime. We're not talking about, hey, we're still back in the late 20s, whatever we were, wherever we are now. We are in a new regime. Get used to it. Disagree? Agree?
We are, and it's a lot like the 90s.
Jonathan?
I agree, but can I also, don't want to do your job for you, God forbid, but can I answer one of the other questions in conjunction with that?
If you're quick.
Basically, this one, can I read it out with the end? Oh, I'm going to get into trouble for this, aren't I? Anyway, with the end of globalization, energy transition, increasing defense spending, etc., surely we're moving into a world with higher long-term inflation. How does AI magically solve all this? I think it ties in a lot of the stuff that we're talking about. And if you want conviction, I don't actually know what the regime exactly is going to look like. I think it's dangerous to think about historical analogues. But one thing which is really striking is one of the most the strangest charts of the last 20 years is the jaws between services inflation in the West and traded goods inflation. So think of the price of TVs in terms of meals. You know, it just got bigger and bigger. And if you'd asked me a couple of years ago, how is that ever going to resolve itself? We need lower house prices here, blah, blah, blah. So all of a sudden, we're starting to see how that's going to work. You can see it coming into view. And that is probably onshoring, as Anne said, climate, addressing climate change, greenflation, if you like. You're going to end up with the opposite of that. So you're going to have traded goods inflation, things getting cheaper, and you're going to have services disinflation, maybe even deflation, closing that gap, because it's a massive imbalance in the world. And a couple of years ago, I wouldn't have known how you would have sorted that out.
Okay. And we still don't.
Well, think about.
No. Okay. Mirko, would investment discussions be better informed or worse informed if investment committee members started by disclosing their own personal portfolio allocations?
Yeah, I think that is a very fair and reasonable question, as is clients actually asking you, where have you invested your money? So, if you're running these model portfolios and the like, and you're not prepared to say, well, that's exactly how I invest my money, I'd be asking the questions. We shouldn't be shirking away from that.
Jackie, if high growth, income, etc., low inflation, wouldn't government policy change influence the distribution of wealth?
I think government policy has been influencing the distribution of wealth for a long time. One of the interesting things with regard to AI and the fact that it'll be knowledge workers that are impacted sufficiently more than lower knowledge candidates, what you will actually see is that the higher wage income quintiles will probably fall and not grow at the same rate. And so then the natural evolution is a rebalancing of the market itself.
Anybody else want to add to that? No? Okay, good. Thank you. Every time I think I'm nearly done. Thank you for your questions. Can the QE genie ever be put back in the bottle? Yes, no, or maybe. Comments?
Sorry, what was the question?
Can the QE genie be ever put back in the bottle? In other words, will the central banks run the same playbook in the event of a major economic downturn, regardless of the inflation consequences?
I think they will, generally. I think they have a standard playbook that has, well, in their view, worked in the past. And to the extent that inflation at the time is at an appropriate level and disinflation is coming down, we are getting very close. I think the Fed will be very quick to move to be supporting the economy because they have a dual mandate.
Inflation is the key, though. How slowly it comes down, is going to be absolutely, the key here.
So that ties in, Ange, if you want to carry on with comment, please. If stocks and bonds are positively correlated at high inflation environment, could you please give an example of negatively correlated asset classes in a high inflation environment? That's the trick.
Yeah, it is. Yeah, it is. I can't, not off the top of my head, I couldn't think about that. But, look, cash, because it is stable, will have very different correlations than bonds will, for example. So that's something to have a look at. I haven't done that work. I'm not sure off the top of my head.
Okay, we're running the clock down, so I'm going to ask... I'm not going to ask the Jonathan question about your super regs. You can pick up that with Jonathan later. I think this is a good last question, and then we'll go to a quick wrap-up, mega quick wrap-up. Otherwise, I'm going to get the prod. How do you be nimble and react to new data, but also not jump at shadows? What's the threshold to be sufficiently convinced? Thank you, Nick. That's a great question. How do we run through that? Let's start with Jonathan and work our way down, and then we'll come to your final summary, which will be a 30-second wrap-up.
I think if you can find corners of the market that are cheap in their own right, decent yield, you think they're going to grow all right, healthcare, Japan, these are the kind of themes that I would sort of get to. And if luck goes your way, they might do really, really well. And if it doesn't, they'll just do okay.
Okay. Ange, how do you be nimble but not jump at shadows?
I think that's a really difficult question to answer because you're absolutely right. You need to hold on tightly, but in the face of evidence that's clear, you do need to change. So it's I guess potentially the bar is different for everyone and how much evidence you need. But you're right. But by the same token, don't jump at shadows. You'll just destroy portfolios with buy-sell spreads and CGT and everything else. So, there is definitely, it's an art more than a science to work out exactly how that might look.
Andrew.
Oh, yeah, I think that's a good one. I think for me, catch-up trade is always a losing trade. You have to get set for whatever you want to invest in much earlier. It's possibly the time when everyone is scared. That's the time you get set for the next things up. As a portfolio manager, for me, that time is when the valuations match. September last year, we were fully loaded because the valuations were very clearly, there was dislocation in the valuation. So it's a valuation question. It's not a question of macro for me. For me, it's each and every asset on what the valuation those assets are at.
That's a good point. Just if you've never dug into it, valuations become really key in every decision you make. Jacqueline.
For me, you never set a portfolio with a single view in mind anyway. You constantly consider your variables and your scenarios and be really clear ahead of time and game plan it what information that you're actually looking for to shift the probabilities attached to those scenarios at any particular time, and ensure that your portfolio is set for multiple different variations.
Thank you.
Sorry, can I just make one more point as well? With SAAs are set for a reason, and if you don't know, just stick to that. So I think Jackie's right that you absolutely should be doing that. But if you don't know SAAs, just do the SAA.
Yep. If it hadn't been mentioned, that word on the way through, my answer would have been think in scenarios. Don't do the Optus. We had no clue what to do if this thing happened. Think in scenarios. That's kind of fundamental to how you deal with this VUCA.
Yeah, I think the scenario analysis is critical to the portfolios. Have a look at what are the things that might play out, inflation for longer, and have a conviction around what you believe. I mean, you've got to stay the course. Being nimble is great, but missing 3-4% days either way can actually hurt, the overall performance of the portfolios. And I think that many people have been guilty of sitting on the sidelines and not knowing whenever to get back involved in the market. So have a plan of action, stay the course, and certainly don't have all your bets in the one asset class. That's for sure.
Okay, we're going to be super quick. It's 15 seconds. I'll cut you off, Jonathan. 15 seconds each. Quick summary of the core proposition you put, because then we're going to vote on this last poll. Jonathan, 15 seconds.
Now is a time to think about the themes that you should be investing in, but do your homework in the next year and hopefully things will come into view.
Ange?
Don't count on old relationships still holding into the future.
Anshu?
Valuation is the all-in thing you can do. So if they are companies with good cash flows, profitability, this is the time to realign your portfolio to the future, to a lot of mathematics we just discussed.
Jacqueline?
AI has the potential to be a third standard deviation event.
And Mirko Kagura?
Be prepared to have a job interview with your client where you're answering the question of what gives you the right to have an opinion about my wealth.
What a great question. All right, thank you all. Let's look at this last poll question. It's been up there for a while. You should have been able to answer it. What's your answer to this question? Is it really different? Some people still disagreeing, that's fine. More people disagreeing, that's not fine. Yes, it is. So there we go. There's the views you're expressing. And the point of this is the little phrase that the forum constantly uses is our role is to challenge what your beliefs are, is to put stuff in front of you that has you saying, I'd never thought of that before. In a sense, our goal is to have you go out of this room more confused than when you came in. So that you're challenged to go, well, what do I really think about this stuff? All right, let's cut out of this and move to the last slide, and then Jade will come up. Okay, there we go. Next one. That's been the theme today. Investing and prospering in a new economic regime really is different. That's been the proposition we've put to you. And we've been delighted to bring a group of people. The forum has a whole panel of people, and these characters have done a whole bunch of work bringing stuff together, not because they've been paid, they haven't been, but because they value learning, and there's a lot of people who do that, and we're delighted to have you as part of that. Thank you very much.